Scomi Energy Services provides services to the oil and gas and coal industry. Scomi Energy Services is a global technology enterprise in the energy and logistics industry with an established presence in 41 locations across 20 countries with comprehensive infrastructure and facilities to support its operation. Their headquarters region in Asia Pacific, Association of Southeast Asian Nations, Southeast Asia. Their place in Malaysia is at Petaling Jaya, Selangor. Their company type is for profit. Alternative and possible competitors to Scomi Energy Services may include Falcon Energy Corp, KS Energy, and Scomi Group Berhad. Certain one-time items, Scomi Energy show that the impairment of goodwill and intangible asset totaling 100 million, the impairment of other receivable totaling 13 million, the impairment of the loan to the associate totaling 4.3 million, and the impairment of fixed asset totaling 1.3 million, had an impact on the loss after tax of 186.3 million. Because of that, revenue was down 18% from 2019 to 2020. This decline is primarily attributable to decreased activity brought on by the drop in oil price and the global COVID-19 pandemic.
Next, I will answer how liquid is your organization. In terms of the organization's liquidity, Scomi Energy Services Berhad's current ratio from 2017 to 2018 declined slightly from 1.36 to 1.17 and then significantly climbed in 2019 to 1.21. Then in 2020 and 2021 respectively, the current ratio steadily declines once again to 0.84 and 0.67. This demonstrates that the business lacks the capital that are necessary to cover its liabilities that are due in a year or less. This is further supported by the asset test ratio, which shows that the company will not be able to pay off all its current liabilities because its ratio from 2017 to 2021 is less than 1 and it is lowest in 2021, which is 0.48. Even though the company's account receivables collection has been faster over the years until 2021, it is still insufficient to pay off its debts quickly. This leads to a conclusion that the company has less liquidity in 2021 than it did in the past.
Are the firm's managers generating adequate operating profits from the company's asset? To answer that question, we can use operating return on asset, operating profit margin, total asset turnover, fixed asset turnover. Based on the ratio of operating return on asset, Scomi Energy had a good rate of return on the asset in 2018, 2020, and 2021. But in 2017 and 2019, Scomi Energy showed a lower rate of return on asset by 4% and 6%. While in operating profit margin, Scomi Energy manage its cost of goods sold and operating expenses efficiently because we can see the operating profit margin is 62% and 68% respectively in 2020 and 2021. Next, I will explain other managers of Scomi Energy generating a good return of equity. In 2017, Scomi Energy received a higher return on equity by 67%, but it dropped drastically until 4.5% in 2019, which means they generate only 8 cents for every 1 ringgit of investment by the shareholders. Hence that, Scomi Energy did not have the ability to return its investment by the shareholders.
Next, I will answer how is your organization financing its assets. Scomi Energy Services Berhad's percentage increased from 43% to 96% between 2017 and 2021. This suggests that to finance the company's assets, debt levels are increasing annually. A high debt ratio suggests that the company may be in danger if its lenders suddenly demanded repayment of their loans, as the company will struggle to pay off its debts and might need to take out more loans to do so, which could put it at risk of going out business.
For total asset turnover, it indicates for every 1 ringgit invested in asset, the company generated 67 cents in sales for the year in 2021, and the company get lower total asset turnover in the previous year. At the same time, fixed asset turnover for Scomi Energy indicates that for each 1 ringgit of invested fixed asset, it generates RM 1.11 in sales in 2021 and again, even lower in previous. This means Scomi Energy Manager practices lower skill of management of assets and does not efficiently utilize them.
What are the factors that lead to the PN17 listing for Scomi Energy Service Sdn Berhad? First and foremost, one of the factors is the investors. The investing fraternity had raised concerns about IJM's decision to hold on to its investment in Scomi throughout the previous few years. IJM was prompted to cut its losses and sell the stake. They were reluctant to put more money into Scomi after it became the largest shareholder in the group in February 2016. Second, the rights issue failed because its share price dropped further to around 4 cents per share, which affected the proposal as the rights issue was proposed at 18 cents per share. IJM is an institutionalized company. The board has to follow when making decisions that may affect the group's value. They did not propose to continue with the investment anymore when Scomi was classified as a PN17 listed issuer in January. Next, the reduction of Scomi's share capital gives rising to a total credit that may be utilized to set off against future losses of the group. No bankers would fund an investor to participate in the rights issuance of a PN17 status company. Scomi is also hard to secure margin financing for its working capital. Other than that, Bursa Securities also rejected Scomi's application for a waiver from being classified as PN17 as there are concerns on the sustainability and growth potential of the existing business and its ability to generate sufficient revenue and profitability. Scomi's growth prospects and profitability are dependent on its ability to commercialize new drilling fluid-based oils to increase the revenue stream. Then, what is the internal risk to Scomi's financial performance? One of the internal risks is production disruption because Scomi and its joint venture partner being terminated from an operations and maintenance contract. Scomi has been making consolidated net losses and operating losses for the past financial years. Besides that, the group sailed through the oil price surge dragged down by a lack of efforts to recapitalize by the shareholders as well as other external factors. Scomi's management had to seek additional undertakings from existing substantial shareholders and getting new investors to meet the minimum subscription requirement.
Scomi International, a new business development arm that the group launched in FY 2017, will be in charge of managing all facets of marketing, advertising, and business development for international contracts. As part of this, operations and maintenance services will be provided. The group's largest revenue producer is still the Oil Field and Marine Services division. The group's total financial performance was negatively impacted by the subpar operating climate in the worldwide oil and gas market, with revenue falling by 40.22%. Operating profitability significantly decreased along with reducing sales. The group recorded a net loss after tax due to the extraordinarily challenging operating conditions encountered in FY 2017 after impairments, taxation, and other considerations. The group recorded a net loss after tax for the FY 2018 due to the ongoing difficult operational business condition from FY 2017 to FY 2018, as well as asset impairments and foreign currency losses. Going ahead, the group will keep running its operations through careful management of operating expenses and group-wide asset realization initiative. As of March 31, 2018, the reduced equity level was mostly due to net losses that had been recorded for the year, but this was somewhat offset by an increase in share capital brought on by the issue of additional shares throughout the year. The lower utilization of working capital lines, which is consistent with our reduced business activity, is the primary cause of the decrease in the group's total liabilities. The share consolidation exercise that was carried out as part of the merger exercise that was carried out during the year is what caused the increase in the group net assets per share. The revenue reported by Scomi Group Berhad for the quarter ended December 31, 2016 increased from RM176 million in the quarter ended September 30, 2016. 56% of the entire income came from its oilfield services section, with the remaining 25% and 19% coming from transport solution and marine services, respectively, with Transport Solutions and OFS recording profit before tax of 3.1 ringgit million and 3.1 ringgit million respectively. The group's QRF1 2017 overall bottom line improved compared to that of Q2 FY 2017. For the quarter that ended on December 30, 2017, Scomi Group Berhad reported revenues of 184.1 million ringgit in 2018 in comparison to the 176 million figure from the previous quarter. This represents an increase of 4.6%. Its marine and oilfield businesses both saw increases in sales over the prior quarter. Due to increased drilling activity in Malaysia and Russia, the oilfields unit's revenue climbed from 124.5 million ringgit to 139 ringgit million in the most recent quarter. According to the group's financial statements, as of 31 March 2017, the project's trade receivables and amounts due to clients on contract were each worth 47.3 million in 2016, 21 million ringgit and 162.8 million respectively. As stated in notes 37 of the group's financial statements, the hearing on this topic was still pending as of the date of the auditor's report for SEB Group, and it was not yet possible to predict how the case would turn out. Regarding the aforementioned, SEB Group has not yet gotten any extensions of the facilities from the lenders that funded the aforementioned project. The group has outstanding loans and borrowings of 213 ringgit.2 million, and in 2016, 219.4 million ringgit from the project lenders that are categorized as current liabilities, as stated in note 19 of the financial statements of the group. Scomi must respond swiftly to lower and raise its debt to capital ratios in the debt ratio case. Among the tactics that can be used include raising profitability, improving inventory management, and debt restructuring. The strategies for lowering the ratio work best when combined with one another, and if the timing of the market is suitable, with an increase in the price of their products or services. The simplest course of action a Scomi can take to lower its debt to capital ratio is to aim to boost sales revenues and ideally profits. This may be accomplished by raising pricing, boosting sales, or cutting expenses. The additional funds can then be utilized to settle existing debt. Improved inventory management is another step that can be taken to lower the debt to capital ratio. The working capital of an organization may be significantly impacted by inventory. It is a waste of cash flow to maintain inventory levels that are higher than what is necessary to fulfill client orders. Companies can assess how effectively inventory is managed by looking at the days in inventory ratio, which is a component of the cash conversion cycle. It was anticipated that operating profit margin would decline. Scomi can do away with poor profit margin products or outsource them to avoid this. Scomi should raise its productivity and make better inventory management decisions in order to guarantee that both total asset turnover and fixed asset turnover might maintain or improve performance.